My role was to find a shop inside Freddie that was working on it that was not supported by management, and the conservatorship didn't know how to do it, and our opposite numbers at Fannie didn't want to do it, and I'm the one who said this was a good thing to do for a variety of reasons, and had the clout to kind of take it.
Broke through kind of this stalemate issue.
So that credit risk transfer is the completion of the securitization business model. Everyone knows about the MBS, it's securitized interest rate and liquidity risk, but left the GSEs with this god-awful concentration mortgage credit risk. That is just not good design for a company and not good design for a financial system. We have taken and completed the securitization business model by separately leaving the MBS undisturbed and TBA undisturbed, gotten credit risk out in greater and greater amounts so that it's broadly diversified through the financial system. That makes us as a company better, that makes the system better. And we did it at an economic cost that is low. That is a good economic thing to do. Being a bit wonky, the cost of capital of CRT has been lower than the cost of capital than buy and hold where you need to raise equity.
Yep.
And we've done that the whole time.
Substantially lower, actually.
Substantially lower.
Totally different.
Markets have been good, so we know it's probably lower than it will be through the cycle.
Right.
But nevertheless, that's what we should be doing. When the cycle is good, take advantage and put it out there.
How effective as a loss absorbing buffer is CRT going to be? I mean, I know predicting the future is difficult. I am bullish on it. There are skeptics, but you're in it every day.
Again, CRT popped up and all of a sudden said you're doing CRT. CRT is a whole range of transactions with different characteristics.
Sure.
One of the things that we know and the FHFA knows is we only got to the end game of a fully effective CRT last year, where the amount being passed through was large, where the accounting worked well, so we didn't have mismatches in timing and all this very wonky stuff. Starting last year, we moved it up so that we started laying off credit risk at 10 basis points attachment point. So almost any loss is going to go out out to the investor, except for the part we hold, because we support it.
10's quite low.
10 is low. It used to be 50. We went to 10.
Yeah.
That is so. We're not just laying off capital risk. We're now laying off expected loss risk. The accounting CECL change upcoming is what motivated that in particular.
I got it. Okay, sure.
So as long as that rolls through the portfolio in the next bunch of years, then more and more is that. When you're in steady state, the answer is we're a packager of credit risk, a credit investor, a manager on behalf of investors, an originator helping the lenders and a processing utility, but we're only going to modestly be a credit investor ourselves.
Yeah. No, it's very transformative. I mean, the types of institutions that are involved are very diversified. You know, everyone wants to see how these things perform in a down cycle, but this is the most innovative thing since the creation of the TBA. I think most people would agree. So it's been really transformative.